Hello and welcome to Cadent Capital's 2026 Economic and Market Outlook. My name is Casey Cooper. I'm here with Christopher Lambert. And today we want to walk you through our current views on the economy, what is working well, what isn't, how we're positioning within the market to take advantage of the dynamics at hand, and also give a little bit of an update on the Fed and the changes that we know are coming.
Casey, I think it'd be great if you started off with just a general macro look on the economy for this year.
So the economy is on shakier ground in our view than we've been for a few years. Now, as you may recall, we were more optimistic in the turbulent 2022 timeframe. We felt like there was enough resilience in the economy at that point in time that we would be able to pull through and keep marching ahead. Today, the change in tone is not that we think we're due for a problem. It's simply we don't have the same solid footing that I felt like we had at that point in time. Ultimately, we've seen deterioration in a few economic conditions that lead to this belief. We are seeing credit spreads tightening. Essentially, that just means that the amount of reward you're getting for taking incremental risk within the relatively safer assets, bonds, you're just not getting paid as much for that next step out on the spectrum. That often is a signal of deteriorating economic conditions, or maybe we could just keep going through that time frame and not enjoy as much reward for the risk we're taking, but the reward is still there. Additionally, we've seen unemployment ticking up. It's not to an alarming level, but nonetheless, if we have more people that are under or not employed, that can start to affect the collective consumer's spending power. Consumers have been tremendously resilient the last few years, so it's not showing up in broad spending trends, but nonetheless, it removes some of the economic slack that we have enjoyed really since post-COVID timeframe. Beyond that, inflation remains a little bit more persistent than we would like to see. Fortunately, the highs that we were experiencing in 2021, 2022, unsustainable levels of inflation have cooled off, but nonetheless, it calls into question the Fed's ability to lower rates, meaning that we may not have the full quiver of arrows available to fight any weakness that could show up. So a little more negative of a tone than we've had for some time, but ultimately there's still more likely to be positive outcome in our view. And this is really Raymond James' viewpoint than negative. As we're showing on the screen, they are rating about a 50% chance of kind of normal market environment. However, they're also expecting a 15% chance of recession or pullback. And collectively, that would be a 65% where we're muddling to negative. Certainly that can sound negative, but on the whole, we would expect more likely neutral to positive than not.
So for the last couple of years, equities have obviously been on a strong run. There's definitely a reason to believe that we should be trimming back a little bit. Would you say that we're going to be trimming back to a neutral stance or going past where we typically stand?
Yeah, and that's an interesting question, especially when we face the inevitable question that resides within it of what specifically are we trimming from and what specifically would we buy, even if it's just going to cash temporarily. One of those is a question that we've been preparing for and now facing the benefit of the outcome, and that's international versus U.S. equities. We were strongly positioned for what we felt like was an eventuality that international equities would outperform U.S. when the dollar started to weaken. Well, over the last year, the dollar has weakened relative to foreign currencies by a little more than 10%. And in that same time frame, international equities are up about 30%, with U.S. equities up, let's just call it approximately half of that. So handy outperformance by international. In instances where we know we're funding upcoming spending, it's easy to trim from those international equities that have done well. But we still like the prospect, given the current administration's viewpoint, that a weak dollar policy is good for manufacturing and America. So we believe there's some timeline still for the thesis of international to perform well, but it does not mean U.S. equities are going to do poorly. U.S. equities were up strongly again, like you suggested, for a third straight year, but it creates room to say, where can we look opportunistically within the portfolio and find some other assets that are attractive to take some risk off the table or rotate where that risk is playing. Specifically, one of those themes is commodity exposures. A commodity is a great strategic piece to have in the portfolio to manage risk. And it doesn't mean reduce return inherently. Really, it just means that in any environment, we have a different asset that could be supportive of spending or opportunity to rebalance. Commodities are now getting to be an attractive price for the first time since the depths of COVID. We are wanting to re-enter this position broadly across client portfolios. I anticipate that will happen sometime in the first half of the year. But again, it goes back to that question of, well, if we're buying something or wanting to add to a portfolio, where do we get the exposure from? And I think coming from equities, rotating to commodity type equities is the logical place to go. Just take some of those chips off the table from the portion of the portfolio that's done well. And if we look within equities, given our strong outlook for international in the near term, I believe US equities are the place we would do it. And even more specifically, US small cap is likely where we would rotate from. And US equities and small cap have done well, but small cap specifically is not delivering the same level of return that it historically did. We believe, can't know this, but we believe it's simply due to companies staying private longer and for fixed income accessing private markets for debt structure longer. Where it makes sense, we've started to populate more private equity and private credit into portfolios, but that's not a solution for everybody. We need to find ways to get that risk within equities. I like rotating to commodities. We're just looking for that right timing.
So we've talked a little bit about the balance between international equities and US equities. I want to take a minute to focus on what's going on in the United States right now. It's a midterm year. I think a lot of times that amplifies concerns, excitement, uncertainty in general. We've definitely had our eye close on that, but also on potential changes coming to the Fed. Mm-hmm. Can you talk a little bit about that?
So with the Fed, we know that Chairman Powell, his term ends as the chairperson in May of 2026, so just a few short months away. There's been a year-long feud with the president or public spat of, will Chairman Powell be replaced or be induced to step down? Clearly, we've made it to the point where he'll live out his term, and it remains to be seen who will be next. What we and everybody else strongly expects is the next chairperson will be dovish. That means accommodative to a lower rate environment as the current administration prefers. And they would be the third of the 7 governors that are appointed by the current administration. So no voting control with them unless Chairman Powell, who has his term as not the chairperson, the governor, lasting all the way through January 31st of 2028, unless he steps down completely and removes himself from the board, in which case the president would enjoy another appointment and a more of a voting block if they vote on Fed matters in unison to really push rates down lower, which could, of course, have some inflationary impacts.
With rates coming down lower, you mentioned a potential dovish chair. I think what comes to mind is our fixed income portfolio. I think that obviously forces us to recognize that there is some tuning up that needs to be done in 2026. Money market rates coming down from their all-time highs, going likely lower than they are today. What is your outlook on how we'll reshape fixed income this year?
So I'll start with a quick refresher. We were enjoying money market rates above 5%. And today, this is in mid-January 26, we're just a touch below 4%. So we've come down more than 1% on that safe money market asset, especially if we have a fourth appointment by the current administration to the Fed, we would anticipate those rates come lower. And we don't want to wait until money markets are no longer attractive and then find that next asset or next step of risk that we want to take, because likely those assets will have already enjoyed some of the early lift of others rotating into it. This is a topic where we think it's worth stretching on the risk budget a little bit, unlike equities where we want to dial back risk a little bit. Here, we can be on the offensive, step out on the risk spectrum a little bit from money market to something else. The answer of what something else is will vary by client and the uniqueness of their human capital and cash flow, and are you in distribution mode, and what other risks are we taking? But nonetheless, getting ahead of just not staying in too much of a defensive position with cash reserves is prudent. That's something that I believe we'll be taking incremental action on for the next year, but it probably will not be a decisive action. I don't think this is a climatic moment. It's more just we want more of the bond risk, less of the cash risk, unlike equities where we want to dial risk back a little bit. So in total, we're just moving from one pocket to the other, where we're accepting of risk and where we're not.
I want to go a little bit deeper on that topic because on the surface, it could be a little confusing.
Mm.
Of course, all the decisions we're making in the portfolio, we want to be cohesive.
Right.
We're talking about dialing back risk with equities, but maybe increasing risk a little bit in fixed income. Can you talk a little bit more about that trade-off that we're leaning into this year?
I think I would use an analogy to start with. Right now, portfolios on average are, if we're talking about driving a car, in the left lane and speeding. Markets have run up, equities are overweight, and so inherently we have more risk residing in portfolios than our neutral perspective, or neutral is called the speed limit. And not only that, in some instances, we're all the way in the left lane and passing, what we want to be. So using that as an analogy, we're trying to figure out not how do we get over to the second lane and down to the speed limit, so to speak, as fast as possible. We're still looking for the safe way to do it. We're being sensible about it. And I think instead of just taking risk back and with taxable portfolios, recognizing a lot of capital gains, or saying, okay, we don't want to have outsized risk, so we'll forego the opportunity of enjoying the possibility of further upside. Let's find the couple of spots where the risk reward is not attractive. So that might be trimming from US small cap, adding commodities. Both still equity risk, but one math favors maybe a little bit more than the other in the near term. And commodities could enjoy some portfolio diversification benefit to boot. The fixed income side, I'm more accepting of taking risk because we're trying to get out of harm's way. Again, going back to the car analogy, we want to get over to that next lane, but what if there's something blocking us in the way? We still need to speed up maybe and get over. Fixed income is like the equivalent of speeding up and getting over, where we're trying to solve a problem of the moment, which is rates are coming down. We expect that to continue, and it won't be attractive to solve later, or certainly not as attractive.
Well, Casey, thank you for your thoughts on 2026 market outlook. And thank you all for listening. None of these recommendations are necessarily urgent. We'll cover everything in our normal annual review cycles with you all, but we always welcome the thoughts and questions in the meantime. Hope you have a great year and looking forward to working with you all this year.
Thank you.